Welcome everyone to another True Potential Do More With Your Money podcast. This is episode 73 and we're recording this on Friday the 18th of June. We were going to be talking about Freedom Monday today until of course that was cancelled earlier this week. But it will take more than that to stop this podcast. So we're still talking about freedom. We're talking about your financial freedom. We've got some handy tips and lessons from our panel today who no doubt still have many lessons to learn themselves, but not where your money is concerned. Let's meet them. We're joined by Dan the Boss Harrison. We've got cool, calm, collected Chris Leyland in the house today. And Phil, your boots, Elvin. Or should that be Phil, should be first time Phil actually on the podcast, because of course I think this is your first outing. Is that right, Phil?
It is, Peter, yes.
Yes, well.
But on the podcast. But, yeah.
Correct. We could only resist the letters and the emails demanding your appearance for so long, so you can stop sending them in now.
I will.
But it is good to have you on, Phil. What else have you done this week for the first time, Phil?
This week, I hit my finger with a hammer yesterday.
For the first time?
For the first time.
Do you want to explain what you were doing?
I was hammering a piece of my house into submission, and I got that angry I missed, and I hit my finger, and that's the first time.
Can we see the finger in question?
You can. I've brought evidence of the...
It looks particularly painful, Phil. Well, I wouldn't ask a question that I'm not prepared to answer myself. So the first thing I did for the first time this week was watch GB News. Has anybody else...
I've watched snippets.
Yeah, watching being the main word, because you can't hear anything until they get the technical stuff sorted out. But if you need any help, GB News, we've got our expert team of Katie and Graham in the corner. They'll just give us a ring. We're happy to help. Chris, what have you done this week for the very first time?
Anything new for the first time? I did a new kettlebell workout. There you go.
Yeah, no injuries?
Very, very exciting. No injuries as of yet, no, but maybe sore tomorrow.
Oh, good. Well, don't ask me for a massage.
I'll try not to. Yeah. It was legs as well, so I'm definitely not going to ask you for a massage.
We're definitely not doing
not
any
that
of
type
that.
of podcast.
Yet.
Wouldn't be your first time either.
Dan, have you broken your duck with anything this week, Dan?
This morning, this is my first podcast as a 40-year-old.
Oh,
There
wow.
Very nice. Yeah.
If we knew we'd have baked the cake.
Well, we should have done.
I think we did. Which is well in advance. Did you celebrate? Well, I know you celebrated, but
I've celebrated with two different surprise parties.
Yes.
So I'm a Grinch when it comes to birthdays, but the team here at TP had a party, and then my wife had one for me on Saturday as well. So
very good.
All surprised out for the next decade.
Is that a new birthday tie you've got on there?
No.
It's a very smart tie. It matches your mug as well, which I can see why you've done that.
Well, Mr. Corporate.
Absolutely. Yes, is your middle name.
I thought when he said it was Freedom Day today, I thought it was alluding to the football tonight.
You just thought I was going to get me Wham records on, didn't you?
Yeah, that's where I was going with it.
Yes, great album. Have you got it?
My better half does.
Ah, see. How did we know? Was anybody genuinely surprised that lockdown got the lifting of lockdown got delayed for another month? And I suppose the second part of that question is: does anybody think it will actually get lifted in a month's time properly?
I think for me, the reality is what you see is that communication come through.
Yeah.
And, there's the YouGov poll where basically they poll people to say, would you be happy if, happy is probably the wrong word, but would you be happy if lockdown was extended? And the poll, I think it was something like 60-70% of people said that they were worried about the new variant coming through. I think from my perspective, looking at it from an investment point of view, the reality is it hasn't really done anything. UK equities were actually up the next day. You've seen sterling come off a little bit, but nothing really has happened. All the big things are already done. It's already open. It's just and this probably is quite an uncomfortable thing to say if you own a nightclub or you own a theatre or something like that. But the reality is the majority of the economy is open overall. So to me, it wasn't particularly a surprise. To the different asset prices, nothing really moved on the back of it.
It does feel like that there's not much left to really be lifted, is there? I mean, I was in London a few weeks ago and just driving around in the cab, and you wouldn't have known at 6 o'clock through the streets of London that there was any remnants of a lockdown. But I mean, nonetheless, still a bit disappointing, isn't it? That we're not quite out of this mask wearing, social distancing.
I think so, Peter. I think when you look at some of the positive kind of steps forward that government's made with vaccination programs, or the 40 whatever million now, I think it's all over 18s can now be vaccinated as well, which is great news. And I don't think anybody's surprised, but I do detect personally, but also when I'm speaking to people, an undercurrent of disappointment with it, which I think people think we're doing our bit here. we're getting vaccinated, we're trying to keep our distance inside of things, we're in the main not taking the mickey and kind of grabbing one another and crowding around and things. Yet, you know, there's, and it's not to underplay again this new Delta variant as well. So please don't get me wrong, we're in there, but it's very minor looking data here, and people are thinking, well, when are we going to draw the line with this? I think there's no surprise, but it is. I think it's this can't probably go on indefinitely now, and it's like, I know they want to get another set of people vaccinated between now and July, but we're getting into the lower age range now, which is, you've got a different demographic of people who may be saying, it's not for me. You know, I'm starting to hear that a lot more now when I'm asking people, which is, I'm 21 years old, I'll be okay if I get it. And you feel like saying, you'll be all right, but but
we might not be.
Yeah, you know, but you can still transmit it, and that's what's maybe been missed with some of this vaccine side of things, which is actually get vaccinated. It lowers your transmission rate as well. It doesn't just help you with your health; it actually stops you passing the thing on. You know, so it's. Yeah, I'll behave. I'll not get too frustrated.
You do sort of wonder as well if cases are increasing to a level that they're unhappy with now. In a month's time, just because of the lag, you'll be potentially unlocking, or giving us full freedom back at a time when the cases will be even higher, the death rate will be higher. Which is if you can't do it now, it's an odd thing to be able to say you can do it in a month's time. But I mean, were you surprised, Phil, or not?
No, conveniently. What seems to happen from government is you already know it's going to happen before it happens through a nice set of orchestrated or unorchestrated leaks. But I wasn't surprised in the slightest. I would probably agree with some of the logic. I would rather get the job done, providing it is the final act. The only worrying thing for me is they're talking about in some of the language, living with COVID. In the future, we'll need to learn to live with it, which is interesting. I don't think that's what anybody would ever want to sign up to. But I don't know whether they might know some information that we don't. But I think if you speak to the majority of people, they think once we're all vaccinated, that's it. Return to 18 months ago. As that's the only thing in the back of my head that's a bit concerning. But the main thing is everybody should just get vaccinated.
I think you're right. This week they were saying it'll end up being a bit more like the flu, where you've just got to have your annual flu jab for a slightly different strain to the one they had the year before. So, Chris, you mentioned some of the kind of market reaction a few minutes ago, but just give us a bit more detail, would you, on the week that's been?
Yeah, sure. So it's actually been a strong week for equity markets. So the UK was up around about 1%. Europe was up around about 1%. I think quite interestingly, if you look at the US, you saw the NASDAQ, so the more technology-focused index within the US. That's been really, really strong, so that's up around about 1.5%. But the actual broader US index, the S&P 500, was actually flat over the week. Probably two data points that I'd talk about. The biggest thing within markets this week has been the release from the Federal Open Market Committee. So they're the equivalent of the Monetary Policy Committee in the UK. So basically they set interest rates in the US. And what they do is they produce a projection to show the individual members' view around when will they first raise interest rates. So this projection has been the same for quite a long time now, and it's basically 2024 is when they're going to raise rates. But on Wednesday, they basically changed that and brought it in to 2023. Now this is important. The reason why they've done that is because basically the economy's strong. You talked a little bit about vaccinations there. Vaccinations are going very well in the US. So basically they think the economy is strong enough to withstand an interest rate rise. Now, normally what you would have seen is equity markets sell off on the back of that. So you're losing some of that monetary stimulus overall. You're losing some of that monetary easing. But what you actually saw is investors seemed quite happy about it, in the sense that I think what they were thinking is the Fed were just ignoring the sort of slightly higher inflation prints that were coming through. So actually, you saw markets generally be quite favourable yesterday, and the NASDAQ did particularly well as investors are looking at those tech shares. They're looking at companies that they think will deliver on earnings, that will still be able to sell their product overall. So that's one thing. I think the other thing, which is maybe a little bit more pertinent to the people that are watching this, is in the UK. So we had inflation data that came out. So inflation data came in at 2.1%. So that was ahead of expectations at 1.9%. Now, it's important in that the Bank of England, their target is to maintain a 2% inflation level. And like they haven't done that. Inflation's been much lower than that for the past couple of years. But I think what's so important about that, and for people who are listening, and maybe we can discuss this as well, is it just highlights why you need to take risk and why you can't use cash products, cash ISAs, cash investments. Because the reality is you've got interest rates at 0.1%, so 10 basis points. So that means you get nothing on your cash, basically. Even we were talking about this just before the podcast started, but even the higher interest rate cash products, you're still looking at 0.4%. Obviously, you've got inflation at 2.1. So it means it's eroding the spending power that you have. So that cash pile, the purchasing power of it is getting smaller and smaller and smaller. And the only way that you can do that is by investing in something. Obviously I'm going to plug our multi-asset proposition, the True Potential portfolios. But, that's a key way that people can invest and make money above inflation. And so for me, that's something that I think is really important for people to take away. The reality is inflation's here. We don't believe, we're going to see very significant inflation coming through, but it's going to be higher than what it was. So it's important for people to think about doing more with their money.
It can be a tricky concept for people to understand inflation and the sort of, or at least the effect of it. But I think I heard yesterday, if you look at I think it's the balanced portfolio since 2015 when you guys launched it.
Yeah.
What's the annualised, if you like, rate of growth over the years since? It's sort of well over 5%.
It's a good question, yeah. So the annualised rate of growth there is around about 8%.
Yeah.
And that's after fund charges.
Right.
So, if we say look at the aggressive portfolio for investors looking for something that's a little bit higher risk, that's over 10% after fund charges. Now, even inflation at 2%, you're still getting a really significant uplift.
And that's the difference, isn't it? It's just beating that 2% figure, which if you get 0.2% in a bank, you're doing exceptionally well, more likely 0.02.
Yeah,
so.
I mean, the other thing as well is, if you think interest rates have been at 0.5% for so many years, so fair enough, they've come down from half to 0.1, but it's basically nothing.
Yeah.
And that really is the key.
Bit of a plug for the marketing team. The Do More podcast last week was about inflation with Greg and the gang there. So probably for a bit more on that.
Flick back to
72.
But it's a funny one, Chris, when you were talking about the target as well. They've been 2%. That's been a target for a long time now, isn't it? And all of a sudden we're starting to lurch a bit closer towards the target. Yeah. And you almost pick up this kind of feeling of, oh no, the doom time.
Yeah. I mean,
it's strange, isn't it?
I think it's weird, I think people are so used to living in an environment where inflation is really, really low. So why is inflation low? It's things like technology, it's population demographics. But the reality is that, the Bank of England, and it's not just the Bank of England, no, if you look at the Federal Reserve, they've got a 2% inflation target as well. The reality is that they're not hitting the target. They're not getting that level of inflation that they need overall. So when people are looking at it, and all the newspaper headlines are like, petrol prices or whatever they are, 18% over the year.
That's true.
It is true.
I've felt that.
Yeah, and people are sort of sitting there and thinking, is inflation going to get out of control? Well, it's not, because you've had a pandemic-related cratering of prices last year, and you saw the oil price go negative, which is crazy. But then what I do see is slightly higher inflation. But I think, to your point, it's completely normal.
Yeah.
It's normal for prices to go up slightly every year. It's normal for wages to go up slightly every year. It's just what happens overall. It's life. But I think people are just ignoring that.
Yeah. Good. Okay. Thanks for that, Chris. Well, let's talk a bit more about some of the, I said at the top, the tips and lessons that we can learn from successive lockdowns, and to give a bit more financial freedom. I've got a newspaper article here, Dan. I think you were in the news at the weekend. I've got it here. It's not
again.
He looks afraid.
Yeah.
Dear Deirdre, for many years I've been struggling. Sorry, that's the wrong article. Sorry, it's on the other side.
Good.
That's a pseudonym I use for those ones, Peter.
Investors' best as pandemic hit Britain's top up their savings, and you were talking about if you look at the amount of money that's been impulse saved with the TP in the first sort of 3 or 4 months of this year compared to last year, 166% increase. And I think you said here people have never been more able to save, including younger demographics. They've begun investing in their future. It's a trend I hope to see continue. And you were talking about nudging 3 billion now extra money that's come into our funds so far this year of inflows, which is pretty amazing. So, I mean, there's definitely a sense that people are saving more. You'd agree with that because you said it.
No, yeah. Absolutely, Peter. No, if you look at the general trend, if you just use true potential as a metric, we're approaching 3 billion of sales as we get a half year. So we're record level of growth for the business. If you use Impulse Save as the mechanism where our clients can make those micro payments into their accounts, that's done phenomenally well. Not just the first few months of this year, because then you could say, well, was that because of tax year end and tax year start? But even last month in May, we had 3,253 separate Impulse Saves last month, which is fantastic, really, because that's just, we always say I'd rather have 3,000 of like £1 impulse saves rather than one £3,000 impulse save, because it's the spread. It's showing more and more people are getting the habit and taking control from within there. And I think some of that is down to people having had more money and then hopefully still enjoying having more money and being able to save it. But I also think it comes from this digital switch, which we saw last year as well, where certainly for us, more people now log into their True Potential site using the app versus the website. Now it's about 60% versus 40% on the website. And I think taking control of your finances is more conducive when you're on a mobile, because I just think it feels more natural now. I think about the way I bank, for instance. I've just been getting a new bit of fitness kit called a Whoop Band because my Fitbit broke, and that's app only. They don't have a website now as well. I've got a business bank account with Starling Bank that is app only now as well. So it's interesting to see the way in which behaviour's changing as well, driven by the tech.
And have you noticed a lot more tech come on stream in the last, say, year or so to help people with their sort of generally manage their money and manage their life, I suppose?
I haven't seen too much more, but I've seen just more people willing to use it.
Yeah. Right, yeah.
I think more than anything, we've all got tales of mums, dads, grandparents, what have you, using FaceTime video for the first time or WhatsApp and things. So it's just, you could read stats till the cows come home, I guess, about this many people use this much more. But I think I always just ask people, and ask people in the office, ask clients when they come in, and they're all up for it.
And would you expect, you mentioned some of the stats there around TP clients, you'd expect that, if you like, more adoption of digital and people logging in a bit more, that's going to continue? We're not going to go back to, I'll jump on the phone or I'll pop in to see somebody. It's
still growing now, Peter. You could argue, I know we're still in the final stage of lockdown, but the growth's still there. So I think it's been cracked. I think, Phil, you speak with your sales director for wealth management, so you look after 750 advisors, and I've always kind of said the advisors are actually worse adopters at times of technology. So you're probably on the front line, so to speak.
Historically, you probably could have said that, but I think the last 18 months has proven that I think everybody is on board with using the technology more, and that's pressure from advisors on clients and vice versa, because there was no other means to transact business. Like if you have money to put in an ISA, you need to do it. You weren't able to write a check and somebody come and collect it and then take it to the bank or pay it in. You had to do it a different way, and obviously we're in a good position where you were able to do that through Impulse Save and top-ups and the like. But you've seen across in wealth management the uptake. We mentioned it before with Impulse Saves, that the figures are absolutely staggering in terms of the amount of clients who are just using the app more regularly. You can spot the regularities when you look at the data. I think when you look at the instances when somebody's used it for the first time, once they've used it for the first time, that's it. They will never go back. And I think the whole UK has done that to some effect with some technology, whether it be Amazon or the TP app or what have you. So to go back to your point, I don't think we'll ever go back.
No.
Which is a good thing.
And you've seen more advisors, if you like, leaving other firms who aren't at that sort of front end
Absolutely.
of technology and joining, say, TP, who
Absolutely,
are.
yeah. So last year, we brought a lot of advisors into wealth management, which is good. One of the consistent anecdotes we heard was where they were unable to operate their own advice business because of COVID constraints. They were literally had their arms and legs cut off. They weren't able to operate. Now, they still had clients who needed servicing. They still had clients who needed to put money into pensions, ISAs, bonds, what have you, and they literally were not able to help them. So we've brought a lot of advisors in who, thankfully, have realised that the technology is there to help them. So it's been a very positive year for us in that respect.
And why do you think, if we've been there since 2007 in terms of digital first and doing things in a very much tech-enabled way, why do you think other firms, perhaps it's taken the pandemic for them to realise maybe we should actually catch up with the 21st century?
I think in part they didn't think that something like that would ever happen. They thought that the old ways will continue. They're not. These firms aren't necessarily set up to innovate or think differently. They're set up to continue doing what they always might have done, and they've assumed that always will be the way. As we know, that isn't the way. Things were already moving to a more digital means prior to that. I think COVID and lockdowns just pushed the accelerator pedal on it and probably brought us forward 10 years.
Yeah.
I think we work in a lazy industry as well. Product providers in particular are lazy. They're a lot of these firms now, these large asset books, would not exist today. If they were formed today, they're living off the fat from dozens, if not hundreds of years in some cases. And they just take advantage of that. And they've just always, I think, like Phil says, always thought it'll never happen. Quite arrogantly, actually, from there. So, we were quite delighted when a good few of those organisations got a good kick last year, and rightly so. I think, like Phil says, they're bad at innovating, they're bad at thinking. I don't necessarily think maybe they're bad at it. They just think they're above it. Why should we change? Yeah,
more laziness, really.
Correct. Yeah.
I mean, we don't want to go through a pandemic again anytime soon, but I mean, in terms of TP, we're not going to stop innovating. We're very much tech driven, and you were obviously the heart of that at the very start. Where do you see the next few years for True Potential from a tech point of view, without giving any secrets away that we might not want to share with our competitors? But
I think it's making our app, it's making our website even more useful for the clients. So we're looking at a project we're calling See Next at the moment, which is going to be taking advantage of like open banking as a type of technology in there, where we can sort of consume clients' bank details. We can then start helping with their savings habits. Everything we're talking about here about saving and spending and things, we'll sort of get the tech to help drive that a bit. That'll then link through with starting to give practical examples as well. So instead of say spending £200 a month on takeaways, if you spend £150 a month on takeaways, save the other £50 a month into your pension, you'll be able to retire three years and 6 days earlier, or something like that. So it just starts to put it in context. But instead of just saying, "Oh, Chris, you should save some money this month," it'll say, "Well, having looked at your bank statement, here's some suggestions where if you just adjust your life ever so slightly, you'll get a real demonstrable difference out of it." So things like that, Peter, I think more than anything, and the TP way in which we try to build technology is always looking at what consumers are doing rather than what does our industry need. So something like Impulse Save, I think I've said this before, Impulse Save was just built from looking at how people would buy things on the internet. Amazon is a great example. We've all used or been tricked by Amazon one click, where you do press it and you're like, a pallet of nonsense is on the way. And we thought, why shouldn't saving be as easy as that as well? So Impulse Save, you log into your app, your card's already saved, in a couple of extra clicks, and you're through, and the money's there. So we just thought, if we make elegant software, elegant, product for clients, financial advisors will do great with it. Financial advisors do great with it. True Potential does great with it.
Yeah. And just going back to the whole lessons and tips, if you like, it's as Dan mentioned, Chris, you can obviously engage with your finances to the point you can do an impulse save and save a few quid, but also you can engage within the app and see what you guys are doing in terms of asset allocation, and just get to know your portfolio a little bit more if you really want to, and get into the detail of it, and as I say, see what you and the rest of the team are up to. It's really useful for that, isn't it?
Absolutely. I think one of the big things that we've been doing, I'd probably say over the last 18 months, is just thinking about how the investment team communicate to clients overall. So we do things such as the daily morning markets videos. And obviously, not just the investment team, but everyone here does a weekly podcast. The reality is that what we want to do is give clients information, and I think for me the most important times to do that, it's important to do that all the time, but particularly last year, when there was so much movement within asset prices, when there was so much movement in people's daily lives, I think it's really important to stay in contact. The very worst thing that you can do is kind of go to ground and not speak to clients overall. So I think the app's great. It's a great way to be able to see your investments, understand how much money you have, as well as that understand actually what's happening with those investments. So have that contact from the investment team, and again, it's just easy to use.
Yeah, I wanted to take you back to the G7 meeting last weekend, and I think one of the key announcements out of that was this idea of tech firms and getting the sort of international agreement around tax for tech firms, which I suppose if you're one of these people who just wants to go and choose your own stocks and invest in some household names, well then that kind of thing can come along and potentially affect you. But if you're in a portfolio with well over 150,000 different holdings, that level of diversification is, it's hedging against one sector or one type of company being affected one way or the other. It's not putting your eggs in one basket, and that's what we're all about, isn't it?
No, that's exactly it. I think the key tenet of everything that we do within True Potential from an investment perspective is diversification. And the reality is, if anyone looks at our performance figures, I think our performance figures are fantastic, and it proves why diversification works. But I do think every so often what you do get is someone saying, well, why didn't you put all your money into, I don't know, something like Tesla, for example, which did fantastically in 2020. But then obviously this year, you've seen very, very negative returns come through from Tesla overall. And what you end up with is basically idiosyncratic risk, because you have it just for one company. And then even if you start to broaden it out, and it was really interesting, I was interviewing someone to work for the IM team, and they were... Are
you off, Chris? Is that it?
Yeah, sorry, bye. And it was
Good luck.
It was a young guy, and he was absolutely fascinated with technology shares. And I kept on saying to him, but you've got to think about the price that you pay for them. You've got to think about just having that exposure to that one area. Think about broadening the portfolio, because actually tech won't do well all the time. Yeah, and that's that's what you've seen. If you look at this year, the key sectors that have done well are things like energy, financials. It's not tech. Tech's lagged. And the reality is, when you look at sectors, stocks, they don't outperform all the time. The worst thing that you can do is look back at performance and say, like, wow, do you know what? That stock was up 120% over the year. Do you know what? I'm going to buy some of that. There's probably a signal that actually a lot of that return's already come through. Yeah. And you need to think about valuation, and you need to think about diversifying your portfolio.
And you can only do that with the kind of relationships and conversations you have with all the fund managers on a daily or a weekly basis, isn't it?
Yeah, exactly. I think the reality is, if someone wants to try and replicate their own sort of multi-asset diversified portfolio, it's pretty hard to do. Yeah. And I think the thing is you can get it wrong. Well, you will get it wrong in reality, because you don't have access to that research. You don't have access to the relationships. You won't have access to be able to speak to the fund manager. You won't have access to that kind of macro overall sort of thoughts that we have. So for me, it's probably easy for me to say this, but leave it to the professionals.
Yeah, and I know the advisors certainly take great comfort from the fact that we've got people like Chris and the rest of the team who are taking that approach with clients' money, because I'm sure the advisors get asked by their clients a lot about, tell me a bit more about the portfolio and the funds, and knowing that there's that level of expertise behind must be a great comfort to them.
Yeah, absolutely. I mean, what you've seen in advice over the past 10, 15 years is more specialization when it comes to the investment piece for the client. Obviously, there's the advisors on the wrapper, what you should do, what your plans are. Historically, advisors sometimes used to create their own portfolios for clients, and that used to be the norm. Or a broker would do it, or they weren't qualified to do it. They were just essentially reading through the FT, thinking, it looks good, I'll have a little bit of that and a little bit of this, and isn't that working well? What you've seen, thankfully, there's a shift towards the professionals, as Chris has rightly called himself there, where it's true, where they've essentially realised that, this is people's money at stake here, clients' money at stake. You need to trust people and give it to a department or a firm who knows exactly what they're doing, who are qualified to do it, and that's their speciality. The advisor's speciality is to look after the client, speak to them about what their future plans are, etc. And Chris and Co will look after the money. That's what they do. Mm. So that's been a positive change in recent years, I would say.
Yeah. What's the biggest, if you like, lesson you've personally taken from lockdown? Is there anything particularly, what are we now, I guess 13, 14 months in?
I think more than that, Peter.
No, it is. You might, yeah. 16 months in, probably.
I think. Yeah.
I just keep saying. I keep saying 18 months. It feels like 18 months at least.
Well, I guess we had a little bit of a summer last year when things were relaxed a little bit. But in terms of properly being under restrictions. But what's your big takeaway been? Is there anything you're going to do differently? We've talked about what advisors and clients will do differently going forward. But what about you?
I was thinking about this in terms of preparing for today, and we've done these podcasts throughout the last 14, 15, whatever months it's been, in terms of giving tips, in terms of saying to people, look, the money you're saving on your fuel and things like that, reinvest it. So I think I don't think we need to repeat those messages, but I've been looking at my own spending over the last month as well, and it's up. So I don't want to be a hypocrite here and say I'm a convert from there, and I don't know if some of it still feels novel going for a meal at the moment and sitting inside, or it still feels novel being able to go to the pub and have a pint or two as well. So I don't know if my spending's up as a result of the novelty side of things, or if I've crept back to my old habits within there. So I'm not going to pretend to be some sort of sage here and give people those type of tips, but I think what I have done is but I always have taken a keen interest in where I spend my money, but also where my money's invested and saved as well. So we've talked about the app side of things. I do use that religiously. I log in at least once a week. I don't log in every day because the type of fluctuations Chris is talking about there. I think, even someone who has access to Chris and the rest of the team, I don't need to see it going up and down every single day. Each week feels about right. Chris, you may even say you should probably just look at it on a monthly basis as well, just to really flatten it out there. So I do that. I do check, where the money's getting spent in the house side of things as well. So that's nothing exciting there, nothing original, I don't think.
But I mean, even away from money, I mean, I know you're very into your kind of fitness, and you were talking about your kettlebells you've been buying. Were they an Amazon impulse purchase?
They were a purchase that I wanted to buy, so I wouldn't describe it as an impulse purchase. But yeah, they're great. I've been really enjoying it. So.
And that sort of side of things probably will, I think the public at large probably will carry on, that taking a greater interest in just a bit of outdoors and getting, which is what everyone's been doing for the last year and a half.
I mean, for me, what I've found is I train in the morning at our local park, and it's got these different kind of exercise things. And in the past, whenever I've walked past them, I've always thought, who uses them? Surely people would just go to the gym. But it's actually been really nice. It's actually really nice getting up in the morning, especially like lovely day today. Getting outside and training is great. So I think for me that's something that's been a big change, and really, really pleased with it.
Anything you're gonna carry on doing or do differently?
I can't keep talking about fitness because we've kind of got the fit side of the table and the outside of the table. I'll key into that a wee bit. Getting outside, definitely. We've been able to do that more. It's one thing. At one point, it was almost the only thing that we could do. So I've done a fair bit of that. But I think the lessons that we've all learned in terms of, I'll talk about from a physical work perspective, the way that we've changed our working habits broadly, I think it has improved. It benefits us here because, as we've been talking about, we are technology driven, so we've actually seen no disruption whatsoever. I think we actually saw productivity go up. I think that's good for a lot of the staff and everybody who works here, where we have adopted what would be a hybrid model. And I think if you look to the future, I think that's a sensible way of working, and it does kind of key back into the money aspect of things. Of if you're going into an office 5 days a week, you're filling your car up, once a week. If you're going into the office 2 days a week, you're probably filling it up every other week. So you'll make a saving there. I just think it's a more hybrid approach for the future.
Yeah, and a hybrid car possibly. Maybe
Well,
it's a hybrid car you're filling up.
Don't get me started on that. I had a courtesy car this week that was a hybrid, and it drank the petrol. I could speak all day about that, but we'll move on.
It resembled a skip though, your courtesy car.
It was a hybrid skip. It performed like a skip, and I think the good thing about it is it's obviously just constantly trying to charge its hybrid bit, but it does so at the expense of the environment, which is probably not what it's meant to do.
No.
So I think it returned like 20 odd miles to the gallon.
So one thing you'll not be doing is buying a hybrid car
Not
anytime
yet.
soon. But Phil mentioned there, Dan, hybrid advice, which we've talked about really since the company was formed, which is what it was all about. Blending technology and the human sort of side of it. But hybrid working, I just wanted to pick that up with you because we're in this amazing building that we talk about a lot, but it's well worth talking about a lot, which you see people in here who are in a hybrid working model, working at home when they can, working here when they need to collaborate. That's surely the way forward. Clearly it is for us, but do you think that'll catch on in the country?
It's it's interesting. You're starting to see some of the sparring going on out there with other organisations. So I talk about them before I talk about us now. So you saw, it was the head of JP Morgan said the other day, if you can go for lunch in New York, you can come in the office in New York as well. And part of me thinks, actually, you're bang on right there. And the other part thinks, it's interesting because I think what you're certainly finding in the States, the different to us Brits, and as far as they're a lot less wedded to a location. It's quite common you'll see someone grow up in one side of the country, go to university in the other side, and then end up working in the middle, and what have you. And apparently what's happened, and we've got US colleagues, and I don't know if Chris gets this from some of the fund management guys as well. During, say, the lockdown in New York last year, a lot of people just gave up the flats, gave up their apartments, and moved around the country on the thinking that I'll probably never be required to come back to Manhattan. And I think that you're getting, but I have some of these banks who are paying, in all fairness, big superstar wages, like Manhattan rates. Manhattan, if anyone's ever been there before, you're talking about like my old thing, £10 a pint. Is what it is. So,
wherever you go in the world,
a man in the world, yes. the pint on there, but it is. It's about £10 a beer in Manhattan there as well. So what these banks are now saying is, well, if you're not coming in, we're going to have to adjust your wage down because we've been paying you a Manhattan loading from within there. So there's an interesting dynamic in, say, on that East Coast, that money-driven side of America. Go across the West Coast, where you have a lot of the tech companies being trendy to start with. You guys will never need to work from home, from the office again, and all that. And then all of a sudden they are. So Apple have said we expect you all back in, and there's hell on with it actually. I think Facebook have said the same.
Right.
Like Twitter is still saying you can still work from home, but given another few years, Twitter will just be completely irrelevant anyway. I think the way it's going. So sorry if we've got any money in Twitter at the moment.
We don't have any.
You won't buy that
positions. We don't have any active positions in Twitter.
But I think it's having an open mind, and I think it's getting to know your start with your clients first, then your employees, and that might sound like a bit of a funny thing to say, but without clients, without the money, we don't have jobs. Full stop. And that's maybe what's getting forgotten a little bit here is that. Can you work from home full-time, part-time, none of the time? It means, can you look after your clients effectively? Can you deliver a great service to your clients? And I think Phil was talking about the productivity before. We did that last year. We looked after, or the staff here looked after our staff and looked after our advisors, and looked after our clients exceptionally well. I've just sort of flash up on the screen there. Behind me, average wait time was 13 seconds throughout last year. So a great result, and probably a result not seen anywhere else. I've just had a cancellation email from Ryanair for a trip which has made me go on next month, and I've got to ring them up. And do you know what? I'll probably not, because I don't want to spend 6 hours listening to Ryanair with some
Hold music.
cheesy music, and from there as well. So I don't know if I've got the time to sit.
It might cost you more on the phone to cancel than it did for the flight.
It genuinely may. So when we go to TP, we could have worked from home all the time forever. We did. You could argue we didn't need to do the work.
Why do you think productivity went up? Sorry, why do you think
more
that was?
time?
It's
Just a bit more time.
Yeah.
If you look at someone like Phil, for instance, Phil used to spend probably half an hour each way driving in each day. And again, I'm just using Phil as an example because I actually spoke to him about it. What he said is, instead of leaving for work now at 7:30, I'll probably start doing a bit of work at 7:30 now as well. So I think some people's working days got stretched out a little bit, which isn't healthy long term. You can't, you shouldn't be doing that. But I think also some people said they felt a bit more rested because maybe at 7:30, instead of getting in the car, you're having your breakfast at 7:30, sat at the table in the house.
That's what I found. I found the 7:30 to 8:30 hour, before the phone starts ringing, before the emails start coming in, you could just blitz through an hour and a half's worth of good quality work that might have taken twice as long in the day when, as I say, your phone's ringing, the emails are coming.
You get that. And what we've actually found, and one of the changes we've made here as well, is flexibility in terms of when we start. So in the past it was always 8:30 to 5:30, but we now have people coming in at 7, and they work 7 till 4, 7:30, 4:30, etc. That's really handy as well because some of our teams do a lot of tasks which are just head down work. We have to reconcile a certain amount of fees and commissions every single morning. That money's already in the bank, so it makes sense for some of those guys to get in at 7 before the noise begins and do it, and then they can leave earlier, of course. So I think that there is some of that. I also notice I've been in every day for the last 7 or 8 weeks in the building, and I probably now spend, and I'm normally at a desk 7:30, 8 a.m. most days now, and I probably spend that first half an hour, 40 minutes talking nonsense with whichever poor person's victim comes and sits next to me, and that's I actually prefer that, by the way, because you get to pick up like what the rest of your team are like. You pick up that vibe, and because what we're running at the moment in the office is we've split the teams into 3. Let's say you're in team 1. Week 1 you're in Monday, Tuesday. Week 2 you're in Wednesday, Thursday. Week 3 you're in Friday, Monday. So I'm seeing a regular, like, different team members coming in, and then you can pick up how well the firm are doing from a kind of. You can tell when people are doing well because their heads up, they're making jokes and things. You can tell when people aren't doing it because heads down, they're moving, or you don't get any fun from them. So from a management point of view, or selfish point of view, I love having people in the building. I
think it's really important, the hybrid thing as well. From if you're in your early 20s, I think you've talked about this before. If you're at that age where you might be living either still at home or perhaps you're in a flat on your own, if your company has switched completely to home working and just shut the office down, the social side of coming to work and seeing your colleagues is clearly being missed on them. You make great play of the social side of TP at the end of the day, but also just having that option to come in for a couple of days and see your colleagues.
I think we're a very social firm. I think we're a fun place to work, I hope. I certainly feel we are. But just with a nod toward that, so when the latest lockdown was extended, we had a bit of a night on it was Wednesday night this week, where we had a couple of the departments in. And we had some beers and we got some pizzas in and things like that. And it was quite good. And Phil, I know you're doing the same with your team on Tuesday. So that social side of things at times is so important. Chris, you've got in your investment management team, you've got a real mix of, lots of experience, but you're obviously having to bring juniors through all the time. So I guess maybe the mentoring side of things.
Yeah, I think one thing that we found is, in some ways for me, it's quite easy for me to work from home because I just kind of get on with my work. But if you're someone who's new to the team, then obviously like, investment is a really steep learning curve. So the reality is it's quite tough for them to pick things up. Yeah. So we've actually been in this week. We've been in the last 4 days, and one of the things that I've been doing with my time is trying to spend as much time with them as possible. So basically, almost sort of shadowing them in some ways to try and help them. So for me, I think when you get someone new on the team, it's just easier if it's face to face.
Yeah, really good. Well, look, I think it's been a really interesting chat, and I think maybe some of the lessons, just to kind of sort of draw it to a close, is engage with your finances. Pick a firm that looks after its clients, as you said, but looks after its people as well.
Yeah.
Use technology to engage with your finance, not just to top up, but to perhaps get to know your finances a bit more, right? Just to understand a bit about what's going on. And yeah, you're right, there's a happy medium. We don't do that every single day, but compared to the paper-based once a year thing in the post that frankly made little sense anyway to most people, the fact that you can log in, whether it's weekly, monthly or whatever, and just see what's happening with your money.
No, I think it is. It's take some ownership, which again, that's a lesson we've talked about. Take personal ownership for your own finances. Take a personal interest in it, and then pick a firm who actually help you match that. If you are, find a firm who helps you do more. So there you go. There's the marketing pitch.
That's a good strap line.
That's a good strap line.
Use
We should use that. Yeah.
And that applies to advisors as well, right? It's not just about the clients, but if the advisors are with a firm that's struggling to just get things done, if you're on the classic, I've got to ring up and spend 6 hours on the phone, think about shifting.
No, I agree. It's about efficiency, really. If you're an advisor and you're looking after 100, 200 clients and you're relying on bits of paper and fax machines, you'll probably be flat out. I think if you use technology and use the hybrid model that's been the theme of the discussion today, really, you'll be able to look after more clients, help more clients, get more clients money at work in the market and all of that. And we've seen a great deal of that over the past few months, 15 to 18 months. We haven't decided how long that's been.
Too long.
Yes. But really that would be the message from an advisor side, that if there's any advisors out there who are struggling with antiquated technology or no technology at all, there is a different way, and it's kind of the true potential way so far. Yeah, good stuff. Normally towards the end we'd ask you what you're doing this weekend, but I'm going to simplify that and just say, is anybody not watching the England-Scotland match tonight? I'll watch it. I probably was going to not watch it, but now that you've teed me up, Peter, I will definitely watch it.
I might not be watching it,
right.
but not necessarily out of choice. So for the first time in quite a long time, I'm actually going to be in Newcastle this weekend. So myself, my girlfriend, a couple of people from the team are going for a drink. However, the one thing we haven't done is booked anywhere, which is the reaction that I've got from every other person
just
when I
take a few cans of beer in a bag.
Just watch it on your phone or something.
You're probably okay with a restaurant, Chris, because they want to be in a pub.
Well, it's weird. There's where I live in Newcastle. I've got a local pub, which is a very nice pub. And they don't show any sport. They don't have any. It is, they don't show any sport. And I rang them to say, look, we're thinking about coming in. They were just like, we're going to be completely empty. There's not going to be anyone in here. And then I thought, well, okay, maybe if we did want to watch a bit of the football, and then Noah's got any bookings, so
just take an iPad. Go to the broad chair, take an iPad, watch it.
Well, there's a big TV just there, Chris. You could stay at work and just,
there's a few of the
chairs.
The platform are in this week, and they're staying late tonight.
Are you watching it, Dan, tonight?
I'm not watching it here. No. I'll watch it at home. But Chris, you've done well not to go to London today. I've got a couple of friends who work on the trains who were full of grown men in skirts yesterday going down.
And then there was the Scotland fans.
And then there's, but there's apparently there's 20,000 Scots in London right now, spreading corona around the country. What could go wrong from within? And I've got a lot of friends who are Scottish, so I'm being mildly tongue in cheek. But it's obviously it's a tradition for the Scots to go down to London, get beat, and then they get to smash London up afterwards.
I don't think they'll get beat.
You don't think they'll get beat?
No, I'm going to say it's going to be a draw. I think the Scottish...
That's a very sit on the fence position you've taken.
Yes, it is. I think the Scottish team will be more up for it. I think history's proven that the smaller geographically and population-wise, they'll be more up for it, and I think the occasion could get to the England players. Now that I've said that, it's going to be like 5-0 to
I think it's going to go the way around. I think the England team are a good team, and they haven't really put a team to the sword for a while. And I think they might be 3 or 4-0.
One of you is going to be very disappointed tomorrow.
That's right.
Why don't we bet a pound on it? If it's a draw, then I'll get a pound.
Like a Scottish pound note.
Yes. Have you still got yours, have you?
I've not spent it. What's your best memory of England, Scotland over the years? Football, I'm talking about.
The
dentist chair.
An easy one, yeah. 1996.
Yeah, I
it was.
remember
Yeah.
It was a great tournament, full stop. That, but it was actually a magical goal by Gascoigne. It was. So yeah, a lot of fun with that.
Yeah. Okay. Well, we'll see. We'll see what happens. Oh, prediction, Chris. I didn't ask you. I know.
Um,
Dan thinks England are going to trounce them. Phil thinks it'll be a steady away draw.
I was looking at the betting odds this morning, and I'm gonna go for England to win. I quite like sitting on the fence sometimes, like Phil, but I'll go for England to win, and I'll go for maybe not as bullish. I'm gonna go for a 2-0.
2-0. Oh well, okay.
I have to caveat it here as a chief executive and say we have lots of Scottish advisors and clients who I love dearly.
Yes. Come on, Scotland.
My girlfriend's Scottish, by the way.
Yeah,
so
there you go. So
It's going to be a spicy dynamic.
Well, you're probably best not watching it tonight, then, aren't you? Just that option of going to a restaurant or a pub where it's not on it probably is the best thing.
She doesn't like football at all.
Oh.
So and she's not that nationalistic either. So she'll be quite happy just going to the restaurant.
Yeah.
Well, good luck with that one. Right. Well, look. Thanks very much to Chris, Dan, Phil. Did you enjoy your first podcast?
Yes,
by the way?
very much, Peter.
Yeah?
Yes.
Good.
Thank you.
Do you want to come back?
I would love to come back, Peter.
We'll have to think about
Especially
it.
if you're hosting.
Well, keep writing those letters in, then, and we'll give it some
Yeah,
thought.
I'll keep my lobbyists going. Yeah.
Absolutely. Thanks everyone for tuning in as well. Don't forget, if you want to catch up with any previous podcasts like the one Dan mentioned on inflation, but also morning markets and a lot of other good content on our YouTube channel, just subscribe to that and it's all there for you, ready and waiting. So if you are disappointed by the result tonight and you don't want to watch any more football this weekend, you can just dine out on True Potential's YouTube channel. So until the next time, it's bye for now.
Subscribing to True Potential YouTube channel is quick and easy. Simply go to your YouTube app on your phone, type in True Potential and press the red subscribe option. You'll then be notified as and when new videos are released.